everyone. Thank you, everyone, for joining us. We're so happy to see you. I'm Julianne Casarino. I'm sorry, let me just say, answer a prompt. Hi, I'm Julianne Casarino. I'm a bank analyst and investor from Connecticut, joined here by my partner, Ian. Ian, go ahead. You want to introduce yourself?
Yes, Ian Green. I run Pendragon Capital, a registered investment advisor. We specialize in small cap banks.
Yes, and so thank you for joining us for our second virtual bank conference that features under the radar banks and investment opportunities. I'm going to turn it over to Mike Godby, but first I'd just like to introduce you. Just to set the stage, banks can be owned differently. Banks could be owned privately by private individuals. They can be owned publicly by shareholders, or they can be owned mutually, meaning owned by depositors. If they're owned privately or by depositors, there's always a chance that they change their ownership structure to a public ownership structure. And in the case of a mutually owned bank, that means that they would sell the stock, the newly public stock, to their depositors first. And these shares are often sold at a discount to where publicly traded peer banks would be trading. And so if you're lucky enough, if you're fortunate enough to be a depositor, it's often a great thing. But for many of us, we're not depositors. We may not be depositors, but there's still an investment case to be made in buying mutual conversion stocks in the aftermarket. So with that, I just wanted to introduce Mike Godby, who's a specialist in this field. He's an authority on mutual to stock conversions, and also on mutual holding companies, which are mutual banks that have gone public, but only partially so. So Mike's going to be sharing with us his thoughts on buying conversions in the aftermarket, what the value that can be found in them, not just in the first day appreciation to where the peers are trading, but over time. And so I'm going to turn it over to Mike. Mike, let me start sharing your screen. You're sharing your slides. Is that good? We're good.
That's great.
Did I get that right? While I get your slides loaded up, go ahead and correct anything that I might have.
That would be great.
Okay.
Well, good morning, everyone. Thank you, Ian and Julianne, for inviting me. I'm a bit passionate about these conversions, given that's really all I've been doing now for 30 years. Started my original 5 years on the road, running little thrifts, conversions from the start to the finish, doing community meetings, talking to local people. But of course, when you're sitting in one of these conversion centers, the professional depositor who has seeded all these accounts over all these years have become very close friends with you in a rather short order. And so I'm here to talk a bit about this conversion game, give you a little bit of 101 to cover a little more what we discussed here a minute ago. These conversions go public through standard conversions, this mutual holding company idea that we just discussed about, where you take a minority of the shares public, and then the mutual holding company second step, where the remaining portion, the majority of it, is then taken to its shareholders through the depositors, and sometimes to the community at large, in the event they can't get the conversion done. And what we're really talking about here is something that historically has been an industry that's been oversubscribing by its members. There are literally 1,000+ professional depositors out there in varying degrees that may have a few accounts to, having almost every deposit account that exists. And these depositors not only have one account, if they've been successful at this, they usually have two and sometimes three, depending upon if they have partnerships or spouses or children under their roofs. But ultimately, this comes down to the risk-weighted returns, the deep value opportunity that's offered to members because of the federal guidelines that were designed for these things by my original boss when he was at Treasury back in the 70s. And what Julian's put up here is first page. It just shows you, and for any of you that actually do business with me, you probably have seen this recently in my conversion calendar, but I've modified it a little bit, to highlight a couple of things that seem to be important. One, There's only 429 of these institutions left. Of that, there's a handful that are double counted because one company has 2 or 3 mutual institutions and just haven't brought them under their holding company yet. And then there's 23 mutual holding companies that are partially public, one of which has 2 mutual institutions beneath it. And part of my discussion a little later on, we'll be talking about these MHCs and the aftermarket opportunities in these things. But I figured I'd also touch base that, there's a reason why mutual institutions go public. Typically it's primarily driven by age of management and need for capital. Now, age of management combined with greed, well, that's a wonderful thing. They get roughly 22% of the outstanding shares of the entire company in the form of goodie packages, ESOPs, recognition plans, and stock option plans. And if they're well capitalized, they can get all of these things. If they're not, they may not. If we're trying to get to the nitty gritty here, most companies are going public usually because things are good times. They see their neighbors going public. They're making money. The stock prices are performing. But naturally, we've had a lot of volatile times over the last 5 years. We've had, 18 was rough in the second half. 19 was rough in the last quarter. 20 will, 20, God forbid. We talk about the complete fall of the COVID cycle, where the market's going up and bank stocks are just falling apart without knowing where credit's going to be. And of course, then we had 21, which is a remarkable rebound. And anyone who's following this stuff this year knows that interest rates are the driving factor to why a lot of these stock prices are down. And the primary driver to this is the bond portfolios having blown up. Rates go up, bond portfolios go down. They get their hit to the AOCI, and all of a sudden, other comprehensive income has put a hole in their tangible book value. And what I'm trying to show here in this page is that we've had a considerable decline in equity at the mutual institutions, and one of the primary drivers is capital. And the average institution here has had a decline of almost 9% of tangible capital. But the issue is very similar to that of publicly traded banks. Guys who lost meaningful amounts of tangible capital have had meaningful declines in stock prices. And guys that are mutual with meaningful declines in tangible capital are now talking to regulators. And those regulators, once you hit about 5%, are wondering, what in the world are you doing? What are you going to do? And in the last 3 quarters, we've had one bank a quarter having to merge out. And the primary driver is tangible capital. And we're going to see more coming into the end of the year. Some of these institutions, remarkably enough, have done sub-debt deals in the last 6 months. Some were doing them last year with expectations that capital was going to go down. Some are just trying to form relationships with neighboring banks that they can merge up with that have greater tangible capital so that they look better to the regulators. But I gave a complete description of virtually every state in this country, and there are a lot of companies under 7.5% capital today. And usually that's a real trigger point for regulatory questions about capital, even though their regulatory capital is usually quite fine. And I even put here, the loans to deposits. These companies look actually very good on average. But everyone wants to talk about regulatory capital and how, the bond portfolios don't affect regulatory capital. That's true. But regulatory capital doesn't give you goodies. And for every dollar you would be raising, every dollar you have in capital, you're going to be raising at least $1 of capital net in a conversion. So if you think about the idea that they're getting 22% of their goodie packages, if they lose $1 and they're raising $1, well, for every dollar they lose, they're losing roughly 44 cents of goodies. And that's enough to kiss some of that golden parachute away, right? I mean, because again, they go public for what? The golden parachute over the golden watch. This is pretty important. That excess capital, by the way, if we go back and we look at the last 5 years of conversions, and I'm sure if I go back further than this, we'd find that the average company is going public with roughly 9 to 10% tangible capital. And the reason is because they get better goodies, they get more goodies. And they get very good comfort that they have money that they can push up to the holding company to protect themselves, to buy back stock, to pay dividends, to be able to get all their plans. Because we've had some companies that have gone public over the last 5 years that didn't get all their goodies because they just about got to 8.5% capital. And the regulators wouldn't approve them getting their recognition plans. And after a couple of years, after the capital has grown, they've gone back out and they've asked for additional goodies. But, up front, a little hard to get those packages if you're undercapitalized. So these companies that are down at sub 5% capital may have a problem getting all the goodies they want. Well, the other thing is that, these companies, they've got management teams that are getting up in age. And one of the primary drivers is age of management. And you've got more than 2/3 of the companies out there that are mutual today that've got a CEO and a chairman of the board who's over the age of 60. Now that might not mean a lot to all of you, but anyone who's following these companies knows that the primary driver to these guys going public is that management's up in age. Sometimes you'll find that guys are going public as mutual holding companies because there was a change of control. A younger guy came in, he pitched the idea, hey, look, we're marginally capitalized or just well enough, but we want to grow. So let's go do an MHC. And sometimes that works and sometimes that doesn't. But look, this capital issue here on these mutual institutions will more than likely fix itself in time. They'll gain some of these securities, will come back, they'll mature off, they're held to maturity, they're fine, they're held for sale, they'll still come back, on quarterly. But look, if the Fed pivots next year and rates come back down, life is grand for everyone. And by the way, no banker is going to go out and try to convince a bunch of these institutions or even an attorney for that amount to go out and raise capital in a rising rate market. They'll wait. So I suspect next year and the following year will probably be dramatically better years for conversions. But this will be all in time. We'll get to watch this stuff and hopefully get to chuckle about it in another 12 months.
Mike, do you want me to go to the next slide?
Yes, if you could, please. So naturally, we talk about these discounting mechanisms. Whenever a bank goes public, they hire an appraisal firm, they go out and they put an appraisal on it, and then they price a discount built in. And if you look at the bottom of the page here, you'll show the first day pops. And now this is only important for those folks who actually have deposit accounts, but it's important that if you're not a depositor, that you understand that, most of the order flow is coming from people who've made, say in fully converted mutual institutions, that 27% rate of return. If they're flipping stock the first day, I make markets. I typically am one of the top market makers in every one of these conversions if I like it. And my clients are going to be flipping for a portion of that. Usually about a third. A third will hold for the next 6 to 12 months, and about a third will hold it for life. And if it's a much bigger institution like an Eastern, where it's a multi-billion-dollar company, you'll have more flippers and more flippers will flip. And we could talk about the mutual holding company second steps, which were, let's talk about the MHCs first. The MHC large conversions, first day pops were actually pretty good. And I'm trying to explain this to you that historically speaking, conversions are put together on an appraisal. The appraisal system for the regulators they have to look at publicly traded companies that actually have volume. So the appraisals for standard conversions, you can find plenty of companies with volume. For large MHCs, you can find plenty of good comps that have volume, which you'll see a bigger discounting mechanism to them. And that's why you get better rates of returns. And often they're a lot more accountable. The kind of management teams that'll actually take meetings. They'll actually talk to shareholders. They usually have excess capital. They usually buy back stock, the shareholder friendly. And because they're sizable, they usually can find some people to dance with them so that maybe they could go find another mutual institution or another mutual holding company that wouldn't mind being taken over by them, because mutuals can't be taken over by anybody but another mutual. And a mutual holding company still fills that definition of a mutual institution. So we call these remuting when it's a mutual holding company, and just an acquisition when it's acquiring another mutual institution. And all that capital they pick up is just that. It's capital that they add straight to tangible book. Not dollar for dollar, but, with a mutual holding company, but dollar for dollar on a mutual. Anyhow, so this is why the larger mutual holding companies have actually worked better. Not always. Some haven't performed either. Some have had bumps in the road. But the mutual holding company, small cap deals, the sub-$1 billion club, their appraisals are based upon larger market caps. And they're not based upon mutual holding companies, at least with all these mutual holding companies before. Most of these were done with mutual holding company appraisals, guys that were very good mutual holding comps that had the built-in discounting mechanism already in place. The microcap ones, though, don't get the same luxury. They can't find companies that have similar market caps, that actually trade. So their appraisals come in much higher than that of the MHCs from the perspective of where they should trade in the aftermarket. And quite frankly, when you factor in these ranges in which banks convert and you price an appraisal based upon a midpoint, next thing you know, you've got a minimum, a max, and often an adjusted max, which is 15% above and then above again. And that can become quite dangerous with an MHC because they literally can be priced 10 to 15% above the average of their peers. And try to tell a professional depositor who's had an account for 20 years not to buy that deal. And a lot of people listen, but there's a portion of people who just want to play everything. And when you play everything, we have found it to be quite dangerous. If we go back and we talk about the last, 30 years of MHCs, we literally still have 8 institutions that are below issue price over that entire period of time. We have 6 that have just gone public in the last 6 years. That's not exactly what people want to talk about when it comes to investing in the easiest call there is, the low risk conversion. But they don't always work. MHCs, microcap MHCs have historically opened up flat to down in the first 2 days. And then they've remained down for an extended period of time. And this list doesn't include a couple of institutions that are already converted and done their second steps. And I'll talk about the second steps now because, they can underperform the first year or two of being public and announce the second step and boom, we're back up. So they can have a good performance out of the gate or above average performance, but then go below issue price in time. And this is when you have volatile days like we've had for 5 years. A number of the institutions that have done second steps spent a portion of their first 3 years of being public below issue price. And a couple of them actually did a second step before they announced on their second year and their stock immediately popped up, which gets into the upper portion of this sheet where I've got an outstanding, a performance for the last 5 years. And what you're going to notice, and in the big highlighted numbers here is what we're here for, is the consolidation. The names that got acquired that pushed up 20% compounded annual returns. And historically, if I go back 10 years, these fully converted mutual institutions have performed almost twice as good.
Did you
Joanne, if you can go back one.
Oh, sorry. Okay.
And that's fine. And if you're a good picker, you can pick the guys that are likely going to be selling because that's really where you want to be. But if you're holding something that's been public for 10 years, it might be on your second management team. They might have gone through a cycle of some sort, and the CEO might have retired, which is why sometimes they underperform. Then you have the mutual holding companies, as I described, have not been great performers. You could break this down, and I did not for the case, for this purpose. But the mutual holding company conversions have been, just what they are. They've, and got it. I think I put in a slide here, and I've got actually something wrong on it, but no, I've got it right. So the MHCs are only up 0.4% for the last 5 years. And that is spot on. I mean, this is crazy that the averages could only be up less than 1% per year. But that number is what it is. And then what I did find in looking at the number here, it's actually, that number is not 13, it's 23. If you put 13 under their pre and post, those companies have actually performed better. And the reason is that they underperformed prior to going to announcing a second step. And those names, when they announced that second step, ended up outperforming even those standard conversions by going up almost 12%. And then post raising capital, they went up 5%. Now, the problem is with this is sometimes they get lower appraisals, and the guys that get lower appraisals actually, or I should say price lower in their range, they end up performing better. The guys that oversubscribe sometimes end up getting getting the higher appraisals and performing less. So generally speaking, we're trying to figure out why things perform better. And it always seems to come down to the same thing. How engaged is management with shareholders? How are they when it comes to managing their capital? Are they good? They're good stewards of capital. What we've found in the MHC structures is that they've been less stewards of capital in general than their predecessors that went public years ago. They don't buy back stock as much as they used to. Sometimes they, well, in most cases, anybody who's gone public since the Great Recession hasn't been able to pay dividends. And fortunately enough, the guys who've done second steps at least got it and had an action in mind. They had a clock ticking. The guys that have remained MHCs just don't have a clock ticking, and that's a problem. Now, Jillian, if you could pop forward one, that would be great. So what I'm trying to show here is really the breakdown of conversion activity. Banks that convert, how many MHCs we've had over the last 15 years, how many standards, how many second steps we've had, how many we've had total. And again, back to this concept. I mean, look, I want to invest in a bank that I can talk to. I want to be able to talk to a CEO. I want to know what they're thinking. I want to know if they have a clock, if they're willing to at least share that idea. Often you're going to find guys with clocks are going to buy back stock. They've got capital up at the holding company. Guys who are fully converted, they're going to pay dividends if they can't get the capital, if they can't put capital to work in buying back shares quickly. Maybe some guys have got acquisitions in mind, but they better be accretable acquisitions. They better have, as investors, they better have a sizable portion of shares in their own company. They better, I would prefer that they not show up to a conference the first year or two of being public so they can buy back shares on the cheap. But, if they do, hopefully they're at least engaging and sharing their perspective to know that they're not going to destroy value.
Present company accepted.
So we've got multiple things that matter, but the most important factor here in performance is the consolidation aspects of the sector. And when you have 85 companies that have been taken out over the course of the last 15 years, that's a meaningful amount of companies. And we're not adding them quick enough, right? Banks are just not converting. If you look at the last column on this page here, on the furthest right, I mean, if you look at that cumulative 5-year totals, I mean, they've been declining all but 1 year for the last 15. So this is a problem we have. We're not replacing publicly traded companies with converted companies quick enough. But ultimately, after having 5 years of volatility, the merger activity has actually slowed down. Guys are not selling as quickly because the peer group that's buying them don't actually have the currency that they had 4 or 5 years ago. So that slowed down the process slightly. Still, if we look out 10 years under 13, you say, well, look, the average company is sold out in 5.8 for 6.7 years, I'm sorry. And, for roughly 47% of the outstanding companies, if 1 out of 2 are sold out within 10 years, life is pretty good for us. Now, each of those years, you could see the accumulated numbers, but the percentage of companies that have acquired in each given year, I mean, look, 18 was a great year. We had 2 companies that sold out. I mean, I think everyone knew the one CMB wanted to sell with the previous CEO that sold 2 other previous banks, but he did the right thing. He bought back stock. When he hit a brick wall buying back shares at a cheap enough price, he ended up giving special dividends. He was shareholder friendly. So always back to those same things. How engaged can management be? How shareholder friendly are? How do they manage their capital? How do they pay out dividends? By the way, historically, guys who bought back the most amount of stock historically have sold out the quickest. So, I mean, I think that covers the slides. Maybe this leads to some questions and we can go from there.
Great. Thanks a lot, Mike. Yes, just as a reminder for everyone, there's a Q&A box at the bottom of your screen, your Zoom screen. You can write your questions in there, or you can use the raise your hand and we'll try to find you, and then you can actually ask it live. We do have one question, Mike, in the Q&A box. Could you comment on the value of conversion investors communicating and engaging with managements after the conversion to keep management accountable to the shareholders?
Well, that's actually vital. And if you've held this company for 2-3 years and you don't see any activity, I mean, there's enough websites today to get not only the CEO and chairman of the board some phone number or cell phone numbers. You might as well call the entire board. You're not getting a response. But look, if you're engaging the CEO and the chairman of the board, and the more people do that, the more he's going to feel like he's got to be accountable. I mean, the average CEO and chairman of the board only hears from their board and an occasional institutional investor or individual investor that shows up at a conference or has been willing to engage them since they've gone public. I think it's vital. And the more people who do it, the better. But don't waste the CEO's time without knowing what you're talking about. You better at least read the most recent filings before you give them a call and start complaining about one thing or another.
Great. So just following up on that, if there's managements that don't want to chat, what do you usually do? Do you just go with that, or do you just keep trying?
Try through an attorney, try through a banker. Look, if I hit a brick wall, I usually just end up selling the stock.
Okay.
I find it very hard to own something I can't do due diligence on.
Interesting question coming up here. What's your potential about credit unions converting? Is that done? Is that possible still? What's your thoughts?
Look, I'm going to tell you, we've traveled around quite a bit since the forming of FIG prior to getting taken over with Janney. And I can remember multiple cycles now where you could sit down with management teams and one by one, each CEO would say the same thing, hey, who are you concerned about? Are you concerned about any of your neighbors doing crazy things? And remarkably enough, for the last 3 or 4 years, I haven't heard anything but complaints about the credit unions. There's not a banker I talk to that doesn't think that the credit unions are extending credit in unreasonable forms, right? Now you can appreciate the fact that they don't have to pay taxes and they can beat you on pricing, but when there's a little bit of lunacy out there in how they're lending and what they're lending in and what credit risks they're taking, that begins to concern not only myself, but every banker I talk with. I think credit is going to be the vital cycle that's going to affect them the worst. Because coming out of the last cycle, they expanded far out of the reach of what they knew, which was consumer and 1 to 4 family. They've heavily gotten into small business as well as C&I lending. And that seems to concern most of the bankers I talk with. Okay. So credit should lead to capital issues. That could very well lead to, much like the OTS having been taken over by the OCC through the last credit cycle, the next recession will more than likely cause that in credit unions, or we all hope in this space. How about that?
So there may be some conversion activity due to capital.
Let's hope.
I'm going to combine 2 questions, two fun questions. I don't know if you have an answer for it, but there's a question about, what do you think your top conversion candidates? And I'll merge that with the question about anything more going on in Eastern Massachusetts after the Eastern Bank. So maybe that's combined questions.
Well, yeah. So the first thing that pops out of everybody's mind is, hey, where's Needham already? the word on the street is already, he would love to convert, but he'd like to convert in an environment where the Fed is actually pivoted. So there's an easy hope and expectation, I think. Look, anyone who's seen one of my mutual lists, or even the most recent piece we published from FIG last week, shows the large institutions that are, sub 9%, sub 10%, 8.5% capital. That I think is a key play. There are multiple companies out there who've gone through the process of doing sub debt conversions. And I think that's the first step into a banker getting into the door in order to do a conversion. So I think there are going to be ample, given how many institutions in Massachusetts are marginally capitalized and only likely getting worse, not better, for the next quarter.
Okay, so we could talk with Mike for a whole day, but we appreciate your time, Mike, and your insights.
Thank you, guys.
We're going to move on. Julianne, you're going to bring on our next guest. Thank you, Mike.
Thank you.